Hey, what up, guys? It's Rhett Weaver from Intraland, Utah. There's two things that I want to cover today: the banking crisis, as far as what happened to us over the weekend, how this kind of affects mortgage rates, inflation, and everything that's going on. And then I also want to talk about the consumer price index that came out today. So bear with me. It's a lot of information, but it's information you need to understand to be able to talk to your borrowers or people in these situations as they get nervous with what's happening in the market. So the first thing that I really want to break down is what happened in the banking system. So if we really take a look at this, this gives you an idea of what the banks are required to do. So, for example, to break this down a little easy for you, if there was a $100,000 deposit, the bank only has to hold $10,000 or 10% of that money. So essentially allowing them to invest $90,000 as they try to make money off of that, right? So they're going to go ahead and tie this up. And there's a lot of different ways that they're going to tie it up, whether it's through car loans, home equity lines, mortgage-backed securities, or other safe investments. So essentially what they're doing is out of that 100,000, they're paying clients a 0.5% or $500 a year in interest. And then they're trying to make $2,000 on the 90% or $1,800 a year in interest. So the bank's going to net around $1,300. And so this kind of gives us an idea of what happened and why we're talking about a run on with the bank. And what that means is as banks get exposed on what's happening, a lot of their, basically money managers will tell these clients to go take their money out of the bank. So as these deposits get less, they have less money to basically pay out. And as they have less money to pay out, then they have to create the leverage by borrowing more money or selling off assets in order to make that happen. With the bank out of California, this is exactly what happened. So, for example, we kind of broke it down already. These are the type of loans at the top: short-term assets, business loans, car loans, home equity lines, mortgage-backed securities. Basically, what happened is where mortgage rates were just over a year and a half ago, we're down in the 3%. So these coupons were around 2%. Well, those investments now are worth significantly less. What ended up happening from a 2008 Dodd-Frank Act is, if they were to hold these to a maturity or the 30-year loan, then everything would have been totally fine. But the issue is the deposits weren't coming in like they were a year or two ago. There's not as much money coming into the bank. So if they try and hold on to these notes with maturity, they just can't get it to the full 30 years. So then they don't have enough money to pay out the people that are coming in to take their cash out, because the banks only have to hold on to 10% of what is brought in. That's the issue that was running into out of that bank out of California. To break this down a little bit more for you guys, let me slide this down and this over. Give me 1 second here. So really what we're taking a look at SVB Bank, they had no risk management officer for 8 months. So nobody was kind of overseeing this. They were still selling basically stock options. And there was even somebody on the news talking about how great their stock options were for these startup companies. Basically what ended up happening from a 2008 ruling is they had a $15 billion loss. And so when they had to go to market and basically sell everything off, they were minus $3 billion on kind of their net margin. So essentially what they were saying is even if they were going to go sell this bank off, they were in the whole $3 billion. What the FDIC did, which is really smart, which needed to happen, and let me kind of show you this. What needed to happen is 93% of that money in that bank was outside of the 250,000. So the FDIC really had to step in, and the government need to pay all the depositors back, because if they didn't, there would have been more bank runs or more banks having people go get their money out. And when they go get their money out, then the whole banking system in the United States of America would have failed. And so what the government actually did, I know a lot of people have kind of had mixed emotions about what the government stepped in and did, but they needed to pay all of those depositors back, because if not, then everybody in the nation right now would be going to take their money out of banks, and all the banking systems would basically be failing right now in the United States. Hopefully this gives you guys a little bit of insight on SVB Bank and what happened. Essentially, they just didn't have enough money sitting inside of their location because everything was tied up, that they couldn't pay everybody back that needed to. A lot of investors also had some of their clients start to short the stock because they knew about the $15 billion loss and what was happening with rates and what was going on in this economy right now. One last thing that I want to talk about is the CPI report from today. So the CPI report basically came out right where it needed to come out, which is exactly where we needed it. Really for the economy just to stay stable right now. But we do want to kind of touch on a few things, and I want to kind of go over some stuff. So the consumer price index is basically the way that we measure inflation. So from year over year, we went basically down 0.4% on the headline and then also the core reading. So we're starting to see that inflation come down, which is really good. The issue is a shelter, which we've been talking about. We keep telling you to circle May 10th as the date. Shelter's still up 43%. So shelter has to do with rents, lodging away, and stuff like that. Now, the issue with shelters is always lagging. And let me kind of pull this graph up. But really, the shelter cost is going to lag pretty hard. And due to that is because, for example, this purple line is where we're currently sitting right now. And this blue line is how the reading kind of stands. So the reading acts like we're at 8.1%, when right now at this month or at this time, we're really at 3% on shelter costs year over year. The issue is when people go to get their contracts for rents, they could sign them up to 6 months earlier. So this information takes about a year to lag, and that year is coming up. So right around May 10th is when that year of lagging is finally going to catch up, and we should see the blue line start to come down. And if shelters put, basically taking up 43% of the consumer price index, that's when we're going to see inflation really start to come down. And we're really going to start seeing things become a lot better kind of in the mortgage area with rates. One more graph that I kind of want to break down here. Let me see if I can pull it up really quick. Really, this kind of breaks down everything as far as the consumer price index. This is the year over year on the right-hand side. This is month over month. As you can see, stuff is still up month over month. And as you can see, some of this stuff is still up year over year. But once we kind of jump into this stuff, that's when we kind of see exactly, and let's show you this graph one more time. The consumer price index here at the top versus shelter, the CPI readings. Next month, we shouldn't really see anything because the shelter is going to be higher than where the CPI report was back in 2022. 2022 of April, which we won't get that report until May 10th. As you can see, the shelter from 2023 should be in line with where the consumer price index was from last year. So this is the first time we're actually going to see relief on shelter, and we should see a lot of stuff start improving. So hopefully between those two things helps you guys better understand what the banking system did and what happened to the banking system, and why this consumer price index, or kind of this reading between the total CPI report and where shelter makes up 43%, they're finally going to catch up and be together. And we stop being in a place where, hey, shelter was a lot higher the year before. It's a lot higher where we are now, still sitting here in the month of March. And then April is when we finally get that relief. So May 10th is the day, and we've been talking about that quite a bit. Last thing that I want to show you is kind of the market overview as far as what's been happening with rates, where we can kind of see everything going. Obviously, with kind of the banking news over the weekend, we saw interest rates really climb here. So on this far right-hand side, again, if this is your first time, green means interest rates are getting lower. Red means they're going higher. So, over the last couple of days, even into Monday, we really got interest rates to kind of drop quite a bit. Today, with that CPI report, interest rates have gotten a little bit worse. Tomorrow, we're going to get a PPI report. It's not as heavy as the CPI report, but it's also a report that really could be bond-friendly. We could see the interest rates get a little bit lower. So hopefully this helps you guys understand kind of a little bit the watered down version of what happened in the banking system, kind of what's going on with the CPI report, and why May 10th is the day for inflation to basically go in our favor, meaning inflation is going to start coming down. We shouldn't see the Fed really talking about raising rates, because obviously if they come out and raise rates, we run into that banking problem a little bit more. We're probably going to see some run on the banks. And so to kind of help your clients understand exactly what's going on and why this bank shut down, hopefully this helps you guys understand that. But a lot of this is just that giant influx of COVID money, how the Fed had rates so low, and then what they're trying to do to combat the inflation. And one thing that you guys should probably Google as well is an inverted yield spread. And that's going to kind of show you what's going on and why that's bad. If you guys have any questions, feel free to reach out. Hopefully this helped you guys. Have an amazing day.